Hello, everyone. This is JJ Richa with Bismal Ventures, and I know messed up his last name, Bruce Itchkawitz. How'd I do,
That's
Bruce?
right. I'm
Oh
doing
my God.
fine, thanks. How are you, JJ?
And Bart Greenberg as well. How you doing, Bart?
Yeah, Greenberg, that's right. You got it.
Thanks. Yeah, that was not the hard one. All right. So today we have two different perspectives on legal for startups. One is from a transactional, and we're going to talk about potentially incentives for teams. And the second one is IP, intellectual property, and what should startups do. Before we do that, I'm just going to briefly talk a little bit about Bismal Ventures and about this program. So the program is about an hour. We will start with an open discussion, questions about the subjects that we just mentioned. Then we encourage you to start asking questions right away. As soon as you have a question, don't wait till the end. As soon as you have questions, please ask them through the chat box that you have available on YouTube. Also, if you have questions that we cannot get to, you can always send them to me, and I'll be happy to forward them to either Bart or Bruce. You can send them to pvinfo@bismalventures.com. This program that we've been doing for the past few months, it's specifically targeting entrepreneur startups in the ecosystem to really help them navigate what it takes to really build and start and build and sell a business or a startup. We're bringing on board investors, entrepreneurs, movers, shakers in the community to really help us, understand what it takes and help our audience understand what it takes to really build and grow and sell a business. Just to quickly on what we do as Bismal Ventures, we are a unique combination of a venture firm and a virtual accelerator and a venture studio, but we also have a software development arm, so we can help our portfolio companies with their software needs. So we help build businesses, we invest resources. That means services in lieu of equity and also cash into our portfolio companies. We also help develop software, we facilitate funding, we open doors to make sure they're successful. We also are building a fund this year. Hopefully by the end of this year, we'll have a fund that would be able to also invest in our portfolio companies. We are a value-based hybrid cash and equity startup-friendly model. We engage on a month-to-month basis, no long-term, and we truly become, because of the way we do things, we truly become business partners with and investors with our portfolio companies. If you have not subscribed to our YouTube channel, please do it right now. You're on it. Also, please don't forget to follow us on any of the social media platforms that are available. Well, thank you for joining us, gentlemen. I would appreciate, let's start with Bart this time. Bart, could you just introduce yourself briefly? Tell us a little bit what you do and what you do for entrepreneurs that I've known you for, what, I don't know, 15 years now.
So again, Bart Greenberg, I'm the founder of Pivotal Law Firm. Pivotal Law Firm is a boutique corporate law firm, and we specialize in working with early stage technology companies. So a lot of our clients come to us wanting to be formed, the entity structure. We work with them on that. We help them on their initial fundraising efforts, typically friends and family, and then organized angels, venture capital, and then private equity. We do a lot of mergers and acquisitions, which tends to be the preferred exit route for most of our clients. And then we do a whole lot of stuff in between. So we do a lot of equity incentives for team members, one of the topics we'll be talking about today, general corporate review. So that's kind of in a nutshell.
Thank you, Bart. Bruce, a little bit about you and your background.
Sure. Yeah. So my name is Bruce Itchkawitz, and I'm a partner at Kenobi Martins. We're an intellectual property boutique. So that means that's all we do is intellectual property. And we have about 270 attorneys. We're probably one of the largest IP boutiques in the country. My focus has been in the patent realm. helping both startups and larger companies protect their innovations. And I bring to that my background as a PhD physicist to work on generally more advanced technologies, whether it's optical systems, gyroscope systems, materials. One of the nice things about physics is it's a broad discipline, so I know a little bit about a lot of different technologies, software included. And I've been there about 20 years, focusing again on helping startups as well as larger companies develop their patent portfolios to protect their investment they're making in their innovations.
Thank you, Bruce. I'll start with you since you just finished. I'm going to start asking questions, and please feel free to answer the way you like. So what are the different types of IP that usually startups should be looking at when they're really starting their business, and how are they protected under the law?
Sure. So the one that I focus my practice on is patents, and they're intended to protect technical inventions. That can be devices, methods of making a device, methods of using a device, compositions of matter. They are protected under federal law. In fact, it's part of the U.S. Constitution that the U.S. should have a patent system. The federal law excludes others. Once you have an issued patent, you can then exclude others from making, using, selling, or offering, including the invention that's described in the patent. But they just don't hand those things out, right? To be protectable, sufficiently different from what is known.
We're losing you, Bruce. Okay, I'll jump. I'll jump to Bart until we get Bruce back. Bart, talking about potentially equity incentives to employees and team members. Sorry, Bruce, we lost you. We're jumping off. We'll come back.
Okay.
Should startups give employees stock or stock options, or what are the incentives, the equity incentives that you usually recommend or see in the marketplace?
Yeah, great question, JJ. And kind of the starting point is the employer really needs to set up something that employees want. And what I mean by that is lots of times I have employers come to me asking about stock option plans, and then I ask them if they've talked to the employees about it, and they haven't. And when they go back and talk to the employees are actually more interested in cash than they are in equity. So, kind of the starting point is make sure that your team really values the stock, and if not, keep working with a cash incentive plan. If they do value the stock, then we're typically looking at setting up a preliminary and what we call an equity incentive plan, which then allows the employer to issue stock awards to all of its team members. The employer's got to decide whether or not it wants to basically give stock to everybody, what I call kind of the Three Musketeers approach, one, all for one for all, or whether or not they're just interested in incentivizing the senior executive officer. So these are all cultural decisions that the employer is going to have to get comfortable with. Once they make those decisions, then typically the most common grants are going to be stock options, which basically is not a stock. In other words, someone does not have a stock certificate that says that they're a certified holder of shares. It's a contract, and basically it's a contractual right to receive shares in the future at a fixed price today, and usually it's subject to vesting, meaning they have to earn it over time. For maybe more senior executives, maybe the employer will be interested in issuing stock as opposed to stock options, but that gets harder and harder to do as the company's farther and farther along. The difficulty here is taxes, is that if you give somebody stock and the stock has value, it's a taxable transaction. So that works really well when the company's just getting started and has no value. As the company starts to grow and has value, and particularly if it's been funded and there's a pre-money valuation established by investors, then stock options tend to be the best route. And I can go into more detail, JJ, if you like, but that's kind of the starting point.
No, that's really good, actually. Bruce, coming back to you, so you talked about the patents and they're protected by law. We heard all that. So a lot of people don't understand what is a utility patent versus what is it, a method, or what are the different types? Oh, we lost them again. Did we? No, we didn't lose you. What are the different types of patents? Utility versus?
Well, three main ones are utility patents, design patents, and what's called a provisional patent. The provisional it's only a placeholder. It's not actually a real patent. Design patents protect the way something looks. They're very specific. They're very narrow in focus. The primary area of patents is the utility patents, or the non-provisional patents. They protect the way something works. They protect technical solutions to technical problems. And they have typically, if you've ever looked at a patent, they describe the bounds of their protection by way of claims, which are at the end of a patent. They are complicated sentences that describe what is in the invention, so that you can compare to a potentially infringing product and determine, does that product infringe the patent or not?
Okay. So the design patent is just how things look. The utility patent, how things work. The provisional is not really a patent. Is you're trying to put a date before you file a full patent. Is that correct?
Well, the provisional is an excellent way to get a date. It basically it serves as a placeholder that you can file at the patent office to say, as of this date, I had this invention in mind.
Yeah. It's
not a patent itself in that you can't assert it against anybody. You can't bring somebody to court because waving a provisional application in your hand.
Yeah.
All it is a placeholder that gives you the option within 1 year of filing that provisional to file the full-blown non-provisional utility application. So it's sort of like saying, I've applied to get a club with which to hit you over the head if you infringe my claims.
Yep. Okay.
There's a date. They're very helpful to get because you need to get something on file at the patent office within a certain time period. You need to get something on file within 1 year of when you first disclose your invention to the public to be able to get a patent in the U.S.
Yeah.
So you can use a provisional to do that. But there's a danger of complacency in that because the provisional is only good for what it describes in that document. And so if you file what you might call a quick and dirty provisional, a one-pager that just describes the top items of the invention, and then you disclose a bunch of other information about the invention, well, potentially that provisional application will not serve its purpose as a placeholder because it doesn't include the information that you disclosed publicly.
Yep. Okay. All right. Thanks, Bruce. Bart, I think one of the things that I really hear from entrepreneurs is that, okay, I'm giving stocks or stock options or whatever, but what happens if people leave? I mean, am I going to lose those stocks that I gave away? Is there any way to kind of claw them back? I mean, is there anything to protect these startups?
Yeah, so the starting point is don't ever give anything that you don't know how to get back, right? And so the last thing you want to do is to have a bunch of people basically no longer involved with the company, who are then basically making money off of the efforts of the team that's left there. And, I mean, for lack of a better word, we call it the freeloader issue, right? These people are out there, hoping that the company's successful, and they're no longer putting any effort into it. And in some cases, maybe the employer says, that's fine, they worked really hard, they earned it. But in other cases, not. And so the point is, we're not saying that you have to repurchase or claw back these things, but you want to always have the option to do so. So keep in mind, with options, they're only earned over time. And so, most people would have a vesting structure that would have what we call a 1-year cliff. They don't earn anything until the first year. So it's kind of a probationary period, so to speak.
Yeah.
And then they'll earn the rest either quarterly or monthly or some other more frequent earning period. But the reason for the 1-year cliff is so that people who don't last a year in the business have earned nothing, and you don't have to worry about recapturing or anything. Same with stocks. Typically, even though if you're giving stocks as opposed to options, typically they're going to have a vesting. Most people have probably heard of founder vesting. And what we're really talking about is that the shares can be clawed back and recaptured at cost, which is typically very low at the very beginning. So that when people again leave the company, that they're not walking away with equity and making money without having to work in the venture anymore.
Yeah. Okay. All right. That makes a lot of sense. Bruce, I have a question from Paul Stein. I'm going to put it on the screen. So Paul said, is not having a patentable product or not seeking a patent the kiss of death for a startup looking for funding from angel investors?
Investors generally want to see that a company has some exclusivity if their business model is based on bringing a particular product or service to the market. A patent isn't required for success for a startup, but in instances where investors are looking for that exclusivity, so that they know that if they invest in the startup and the startup does all the effort to show the efficacy of the medical device, for example, that some of the big players can't just come on in and take the market from them.
So there's
you
some
like
moat,
to have
right?
that exclusivity.
A little bit of moat. There's a moat.
Well, yeah, right, and a fence and a wall and those spikes. You like to have as many as is necessary and reasonable. I mean, because it can be a bit of a black hole to keep throwing money into the patent process. So you want to make sure you have the appropriate level of exclusivity, and that means not just looking at your particular product. That's an area where I see startups sometimes fall down in the process. That they think, okay, well, I've got some narrow claims that just focus on my particular product that's going to go to market.
Yeah.
But that leaves the problem that somebody else can maybe tweak one or more aspects of the product and get around your patent. And then what that is, it's a gaping hole in this wall, or it's a bridge or a moat, to use your analogy. So you need to be mindful that you're not necessarily trying to just get protection for your particular product. You have to have some forethought to think, how might others try to design around my product, and then put barriers in place so that they can't use those avenues to get around your patent.
Yeah. Okay. All right. Thanks, Bruce. We have a couple questions for you, Bart. Patricia says, where would you recommend drawing the line between use of options and use of profit interest unit shares to incentivize key advisors or employees?
So we haven't talked about profit interests yet. Profit interests are typically only used in limited liability companies. I mean, they can be used outside, but historically, that's really where they're typically used. So kind of the basic answer, Patricia, is that we'll use profit interests in limited liability companies and stock options in corporations. Let me just explain briefly what a profit interest is. And so in a limited liability company, options really don't exist. It just, the taxability and the accounting treatment are still very unclear. And so we typically use these things called profit interest. And again, remember earlier we talked about the fact that you don't want to create equity incentives that tax the employee at grant at the very beginning. So if we were to give an employee a limited liability company membership or unit that actually had value, then they'd be taxed on it. So we create these things called profit interests. So let's say the limited liability company has a pre-money valuation of $2 million. And let's say they have 2 million membership units outstanding, so the units are worth $1 a unit. We then would have the employee receive a profit interest, and what the profit interest says is that the employee will not participate in the first $2 million of profits from the company's sale. And they'll get everything above 2 million. So what they have is what we call a hurdle. That hurdle will be $1 per unit. In other words, the fair market value, what the units are worth today. So the employee is getting everything up and above the dollar. So if the company doesn't grow in value, the profit interests are worthless. And if the company does grow in value, then they'll receive the difference between the dollar, the hurdle, and what the fair market value is at the time of exit or the time of termination of the company. So again, to answer your question, we're really only looking at profit interest in a limited liability company context.
All right, thanks. So there's another question from David Friedman. David says, how do you determine if you should be an SCorp, a CCorp, as a startup? Can you start as an S and then convert later?
So, hello, David. So this is a hard issue in that a lot depends upon the circumstances. So people are out there pushing this drug, as they call it, which is that if you're a startup, you want to be a Delaware C Corp. Okay, and what I tell people is to ignore the guys pushing the drug on the street. So California Corp, which we don't have the time to talk to, but let's talk about the difference between the S and the C. So for a C Corp, it's a double taxed entity. And a lot of people will say, well, hey, I'm a startup, I'm not profitable, so what do I care about double taxation? And the real key is that if you're an S Corp, it's not just profits that pass through, it's losses. And so if I'm an entrepreneur and I plan to put a lot of my own money into the startup, and if your startup's typical, it's going to lose money the first year or two, then you can take those losses and use it against your other income. And if you're filing a joint return with a spouse or partner, you can offset his or her losses as well. So, just to throw out some numbers, if I have a 50,000 loss I can use and I'm paying an effective tax rate of 40%, then I'm going to get 20,000 back. So being an S Corp can be a very effective bootstrapping mechanism to take actual current losses and turn them into cash by basically saving taxes off of your return. Now, if you're an entrepreneur who's not putting money into the company, then you're really not going to be able to make use of those tax benefits. The flip side is that if you're a C Corp and you buy your stock and investors purchase stock, then there's something called the Qualified Small Business Stock Exemption, which basically allows you to write off, in other words, not pay taxes on the first $10 million of gain. That's right, $10 million. Again, if you're in the 40% bracket, that's $4 million of savings. So the numbers can be huge. So the real question that I kind of ask my clients are, if you're not putting money in, I think it's an easy decision that you probably want to be a C. If you're putting money in, then you have to ask yourself, is the value of the losses and the tax savings coming in today going to outweigh the potential of having a very large exit down the stream and being able to save those taxes? It's a hard thing to ask, it's a hard thing to predict, but I think that's the starting point and the right way to look at it.
All right, that's. I have a follow-up, but I'm going to ask Bruce a question. Bruce, again, I think this is one of the things that puzzle me and puzzle a lot of startups. What determines whether a patent end up being granted or not granted? Are there specific, rules around that?
Absolutely. I mean, and that's where the battle is joined with the U.S. Patent Office, convincing them that the invention described in the application meets the standard for patentability. And they're basically two of them, but I'm going to talk about a third one as well. It's particular for software inventions. First, an invention has to be novel. It has to be new. It has to never have been out there previously in all of the information that's publicly available. That one is generally easily met because a startup isn't putting a lot of time, effort, and money into developing something that was already out there.
So, Bruce, are you saying there's still things that you can patent? I thought we're done. Everything's been patented.
Well, they are. They patent. There are thousands of patents every year. That novelty issue isn't generally the one where they get tripped up, though, at the patent office. The second one is actually more prevalent, which is that an invention has to be non-obvious. In other words, an invention can't be obvious in view of all the information that's publicly known.
Okay.
And so that means that typically when an examiner at the patent office is making that argument, or maybe you already have an issued patent and you're trying to assert it against somebody, well, that company that you're asserting it against, they're going to try to show that the patent is invalid for one reason or another. And one of the primary reasons is that it's obvious in their view. And that's if you take some of what's in one reference and some that's in another, you have some reason to combine them together, and that's the invention that's described in the patent. If that argument can be made, then the patent is invalid, or the patent office will not issue the patent.
Okay.
I think I have gone out, or maybe my voice is still.
No, you're back. Yeah.
Okay. So just briefly, with regard to software-based inventions, there's another important standard that the invention can't basically only be an abstract idea. It can't be a mathematical algorithm, which, if you know anything about software, that basically software is an algorithm, right?
Yep.
And so unless the software is providing a technical solution to a technical problem, there can be rejections of the application or even invalidity of an issued patent down the road if the argument can be made that, no, this invention merely is just using a computer to do things that were already known to do without a computer.
So that's interesting. So it's back to, I don't know if you're still hearing me, but it's back to exactly what the original patent idea is supposed to be, and that is it needs to do something. Otherwise, the software is not patented.
I think I went out again.
Okay. All right. Are you back, Bruce? Okay, maybe not. All right. Let's see. We have a question from D. Toby for you, Bart. And he said, Bart, when and where do you recommend the use of IRS Section 83B? That was going to be my next question, Toby. But so maybe, Bart, you can talk a little bit about what is an 83B and what is a restricted stock?
Yeah, we get asked that a lot. It's a great question, Doug, and happy to respond. So one of the areas of confusion is a lot of people talk about, should I make an 83B election on my stock option? The answer is no, because you can't. Okay, it doesn't apply. So in order to understand 83B, let's talk about 83A. Okay, what 83A basically says is that when an employee or service provider gets stock, and that stock is subject to restrictions, okay, and specifically it's subject to a risk of forfeiture. That's the term that we need to understand. Then the taxpayer is not taxed until those restrictions are removed. So let's kind of break that down into plain English. The first thing is, what's a risk of forfeiture? Earlier, we were talking about the company being able to recapture and take stock back when an employee leaves. And although that's a recapture or a forfeiture, it's not the type that the IRS is talking about in the 83A, 83B election. When we talk about a risk of forfeiture, we're talking about a loss of economic benefit, okay? So if I receive stock that's now worth $5 and somebody's gonna buy it back at $1, then they're cutting out $4 of economic value, okay? That's what we're talking about with a risk of forfeiture. So if I receive stock, and if I can have my value taken away, in other words, it's basically subject to vesting, I have to earn it over time. And if I don't earn it, they're going to buy it back at cost. Any buyback at cost, any buyback other than fair market value is going to impose a risk of forfeiture. So what 83A says is that I am taxed when those risks, those restrictions go away. Now here's the hardship. So let's say I receive 100 shares and they vest annually 20 shares a year over 5 years. And let's say those 20 shares are worth $20 year one. No big deal. I'm going to pay taxes on $20. Well, let's say in year two, those 20 shares are now worth $20,000. All right, I've got to pay taxes on $20,000. $8,000. Year three, let's say those 20 shares are now worth $2 million. Well, now it's starting to get uncomfortable, right? Now I've got to pay tax on $2 million, and I don't have any cash to make the tax payment, so it creates a real hardship. So that's 83A, and 83A can create a real harsh situation for the taxpayer. So if you're in a world that would be taxed under 83A, 83B is my election out of 83A. What 83B basically says is that I don't want to be treated under 83A. And in other words, in order to make the election, I'm going to pay the current fair market value of the stock today in taxes. So if you remember in our example, the 20 shares were worth $20. So the 100 shares were worth $100. I'm going to pay taxes on the full $100 today. All right. So I'm going to pay maybe $40. But that protects me against the harsh situation of having to pay taxes downstream as those restrictions go away. I will never have to pay any more in taxes than that initial upfront value. So to kind of summarize, I'm going to want to make an 83B when I receive stock that's subject to vesting, subject to a risk of forfeiture, and I don't want to pay taxes downstream with the risk that the shares are going to become more and more valuable and my tax obligations could be considerably higher.
Great example and explanation, Bart, because a lot of people are confused about that. And 83B, also there's a lot of risk because you could pay for the tax now and
right.
The stock could be worthless down the road. So there's that as well. So
yeah, I mean, if the stock has any real value today, and that's what we talked earlier in the presentation, I'm probably going to election rather than the stock, because even the 83A election, the 83B election could be painful if the share is worth money.
Right, because you don't know. Yeah, exactly. All right, Bruce, Patrick Flynn, a former TCA colleague, is asking you, with the cost of filing a patent in multiple regions and significant cost with defending patents globally, it seems this is not the best way to use precious capital. What are your alternatives?
Sure. So first I want to apologize for the internet issues I'm having. If anybody was unable to hear my full answer to any question, or you have any other questions, please feel free to drop me an email and I'll make time to talk to you about that question if I wasn't able to impart the answer during this fireside chat. So there is no such thing as a global patent, unfortunately. So what that means is you have to, anywhere where you want patent protection, you have to file a patent application. Well, those fees, thousands of dollars per country, they get huge. So for startups, that's generally, it's correct. That's not a good use of capital to start trying to go into to many countries as possible. What you want to do is focus on where you think are the choke points. Where are the markets that you're interested, that have the biggest value that you plan to go into with the patented invention? Where potentially are the primary areas where the invention might be fabricated? Because if you can get a patent in that area, you can stop the competitor from even manufacturing the product. Generally, the U.S., though, is the primary market that startups are interested in. And so a U.S. patent can do most of the heavy lifting that is needed. Because even if somebody tries to import a copy of your invention into the U.S., a U.S. patent can stop that importation at the border, presumably.
Okay. All right. Bart, a question for you. Again, I think we're going to stick to the stocks. So, what is a phantom stock?
A phantom stock is a ghostly version of stock. So what we mean, it's transparent. It's not really stock. It's spooky, right? So from a legal point of view, it's not an equity. It's not equity. It's not a security. And so one of the benefits of phantom stock is that the company doesn't have to worry about securities laws exemptions, which we haven't talked about yet. But that's one of the main benefits. One of the other benefits of using phantom stock, again, because it's not stock, is that the recipients don't have any shareholder inspection rights. So people who have stock have rights to inspect the books and records.
Right.
I've had several clients who have just been burned by employees having stock, and they've harassed them, by asking for the financials every month and coming in to do inspections, and they have the right to do that. But it can be used as a real methods of harassment. So some of my clients have been so burned in the past by employees that they just won't even give it anymore, and they use this thing called phantom stock. So phantom stock is kind of easy in that it's really just a cash bonus plan. That's all it is.
Yeah.
What makes it a little bit unique is that what the employee receives is tied to the value of the company's stock. Okay, so it tracks the equity, but it's not equity. So I come into a company and I'm given a phantom stock grant. Let's say I'm given 100 units of phantom stock. And at the time I come into the company's units are worth, or the common stock's worth $5 a share. And then when I leave, let's say the company's common stock is worth $20 a share. Then I have the ability to basically get a cash bonus based upon the growth. So 100 phantom units, I think I said, $15 growth per share. So I'm basically looking at $1,500 worth of value. And so I would receive that as a cash check, essentially. So I never own the shares, but I basically, I'm getting the same financial upside that I would have had I owned the shares.
That makes sense. So it is a really good alternative for certain situation. It has to be the right potential situation. Bruce, something that I always hear, and that is, why do we need to do a search? Can we just file a patent and just do it? I mean, maybe tell us a little bit about patent searching. What's a good
Sure. Sure. Well, right. Well, you're right that there is no obligation to do a patent search. I mean, you don't have to do a search. You can just, file a patent application at the patent office. The only obligation there is if you are aware of things that are out there that are potentially relevant to the patentability, you have to disclose them to the patent office. But if you want to, just bury your head in the sand and just not go out and investigate what other things might be out there, you're free to do that. Of course, you run the risk that the patent examiner, when he or her is doing their search, they're going to find some low-hanging fruit that's out there that describes your invention to some level. Yeah. So the benefit of the searching is to try to find that low-hanging fruit, and then to take that into account when you draft the patent application. If you find something that's particularly close, well, then you draft the patent application focusing on the things that are different, so that when that examiner finds that reference or even looks at that reference because you've had to disclose it, you've already taken that into account in what you're asking for, and you can avoid potentially some rejections that you might otherwise get.
Okay.
And
all right,
people can do some keyword searching on their own, right? Rather than spending hundreds of dollars on doing some searching, if you're just looking at like a sanity check, you can do some Google searching on the using some keywords that describe your invention. See what pops up. The patent office also has a keyword searching capability at uspto.gov that you can use to see, okay, what other patents or published applications are out there that might have used the same terms that I'm thinking of using to describe my invention.
Because they're all public anyways, right? So yeah, you can use the USPTO to be able to.
That's right, but there is one aspect of it. They're not all public in that the only things that are public are things that are 18 months after they were filed.
Right,
so there's always that black or that blind spot, you could say. 18 months, somebody could have come up with the same invention 6 months ago, filed a patent application on it. You won't know about it until another year goes by when their patent application is published.
Yeah.
So, you have to take...
I actually meant, you're right. I'm glad you said that because I actually meant the issued patents, they're public. Yeah, so, but there's
Right.
that whole, yeah.
Yeah, I mean, that's part of the reason there are patents, is to make knowledge public. Because
Right.
the patent system is supposed to allow others to build upon the innovations of others. So a patent, that's part of that's part of why patents are different from trade secrets. Patents eventually become public, the information in them become public. Whereas trade secrets, by their very nature, don't become public.
Okay, all right. Maybe we'll ask about that. Let me jump back to Bart and ask him about, we talked about stocks a lot and 83B and the phantom stock and all that, but maybe you could tell us about the different types of options that are available.
So there's basically two types of stock options that are available, referred to as incentive stock options, which are also sometimes referred to as qualified stock options. And if something's an incentive stock option, it basically means that it fits all of the definitions of Section 422 of the Internal Revenue Code. Okay, so if it meets those requirements, it's an incentive stock option, and if it doesn't, it's not. And the not incentive stock options are referred to as non-qualified stock options. In other words, they're not qualified under Section 422 of the Revenue Code. So here's the similarities and differences. Okay, if each of these options is granted at a fair market value exercise price, and we can have a whole nother conversation about that, then none of them are taxable at grant. Okay, so they're both treated the same at the date of grant. The main difference is on exercise. And so if I have a non-qualified stock option, when it's exercised, it is taxable. Okay, and this is taxable income. Okay, so for the employer, that means withholding, FICA, FUTA, matching taxes, all that good stuff. So let's say a person has an option for 1,000 shares, $1 a share. They're now worth $10 a share. Then they've got $10,000 worth of, $9,000 of taxable income, right? 10 minus 1 times 9 times 1,000. So the employee is going to have to pay taxes on $9,000 of taxable income. That's a real hard thing to do, especially if the company doesn't have an exit, okay? Because it kind of goes down to the point, are you going to go at risk? In other words, pay for the option, pay the taxes, and what if the company fails? That money's gone to the tax man, right? Yeah. So it wasn't a great decision in hindsight. So the nice thing about an incentive stock option is that at exercise, it's not a taxable transaction. So it does allow the employee to exercise the stock option, hold the shares, and not have to worry about paying any taxes. Now, here's the rub.
Until the exit, potentially, until there is an exit.
Until the exit, exactly. Okay, now, the rub here is that you can disqualify a incentive stock option or qualified option if you don't do certain things. So number one is when you exercise, you have to hold the shares for a year. So if you exercise and the company sells right away, flip and sell the shares, then it's converted into a non-qualified. Or if you hold the shares for 9 months and the company sells, then you wouldn't have held it for 12 months. So again, you're going to be taxed as if it was a non-qualified stock option.
Yeah.
The other thing is that you have to hold the shares for at least 2 years from the initial date of the stock option was granted. So there's a whole series of rules that if you don't comply with it, you're going to basically disqualify the qualified status. So the short story is make sure you understand what those disqualifiers are. Usually the employer will give you some information, But if you do everything correctly, you can avoid paying taxes until you actually sell the shares.
All right. So, Bart, you're saying that it's complicated and someone needs really to talk to you to really do it right.
Yeah, I mean, it's a great idea to talk to somebody in a perfect world. In a perfect world, I'm expensive. I cost not that expensive, so don't get scared off. It's more expensive not to call a lawyer.
Not good marketing, Bart. Not good marketing.
I know, terrible. But that's what happens when you're an honest guy. The short story is, I would start with Google. Google. There's great information out there, but don't end there. Always call and get it qualified. Confirmed by somebody who knows what they're talking about. One of my favorite websites is Quora, Quora. Quora is a great ask and answer website, and it's searchable, so you'll be able to find stuff that people have asked and have been answered before, or you can post your own questions. But again, my point here is it's a good starting point to understand the area that you're in. It's important for you to kind of educate yourself, but then make sure you get some professional involved who can make sure and confirm it. And second of all, the laws change. So you may find a lot of good information of a law that's been changed and is no longer applicable.
That's very true. All right, Bruce, we talked about trade secrets. So tell us, what's a trade secret? Is it protectable or not?
Yes. So a trade secret, it's in its name, basically. Okay. First off, it has to be with regard to trade. So it has to be information. You can protect information that provides an economic advantage as a result of the fact that it's not publicly known. It can be anything. It doesn't have to be technical information. It can be customer lists. It can be internal ways that you operate. The other aspect is that it has to be secret. You have to have put into place some reasonable measures to protect its secrecy in order to try to go to court to protect yourself if you think that someone has stolen your trade secrets.
So let me ask you, Bruce, is a perfume formula a trade secret, or maybe a recipe for food? Could that be a trade secret?
Absolutely. Although if it's something that could be reverse engineered, then trade secret can't protect you. I mean, if you're going out there and selling your product, and someone, let's take your perfume example, can buy it and then do whatever analysis they need to figure out exactly what is in there, well, you can't protect it via trade secret. The only potential way to protect that would be the patent process. Right. And so,
all right. Go ahead.
Yeah, I was just going to say that, it's not, you have to, in order to be able to bring a case to protect your trade secret in a court, you're going to have to tell the court what is the secret, and of course, they'll keep that secret. It's for their purposes of deciding, what information is being alleged to have been stolen. But then you have to show that you put some measures in place to protect it. You can't just, leave it out on the shelf, at the reception desk where anybody coming into your office could see it. You have to take reasonable measures to protect the secrecy.
Okay. So really, perfume is not, because you're going to have to give it away eventually. So it's not going to be a really trade secret. All right. So Bart, let me ask you, maybe we switch subjects a little bit and talk about, this may be too long, so maybe we could, try to summarize it, because I know it's a very long subject to answer. We're seeing lately all the different types of funding, from equity rounds or priced rounds, and we have the convertible notes, and we have the KISS and the SAFE and all that. But maybe you could tell us briefly what's the difference between maybe an equity round or priced round and maybe a convertible note, and which one is better? And this is a hard question to ask. Which one's better for the investors, and then maybe which one's better for the startups, entrepreneurs, or is there one that's really fits both?
Yeah, let me try to handle this a little differently since it is a lot, I talk on this topic, and for an hour and a half. So
Yeah.
it's a little differently. So on a priced round, we're talking about typically either common stock or preferred stock. Okay. And that basically means that we are going to put a value on the company's shares, and the investor is going to invest based upon that value. The difficulty, of course, is that the founder and the investor have to agree upon what the company's worth, and that's not necessarily an easy thing. Okay, so what we're putting into the bucket of a priced round would be common stock and preferred stock. Common stock basically means that the investor is getting the same stuff that the founding team has. Preferred shares means that they're getting shares with a preference. They're going to be treated better. They're going to get cashed out first, is what preferred shares typically mean. I wouldn't recommend doing a preferred round unless you're raising at least $500,000, because the legal expenses tend to be a lot more expensive than what it would be with some of the unpriced round mechanisms that we'll talk about shortly. So kind of my threshold is don't even think about a preferred round until $500,000, and more typically, don't even think about a preferred round unless you have professional investors coming in. Because what you don't want to do is screw up the cap table of the company by having this badly issued round of preferred shares that you shouldn't have done, and it just kind of makes the cap table difficult to work with. It's one reason an investor may just look at this and say, this is the deal for me. They just may not like the cap table that they're being asked to do.
Yeah.
So again, priced rounds, common preferred. In the non-priced round, let's kind of talk about what they are. We have convertible notes, we have safes, and we have KISSes. So let's talk about how they all work generically, and then I'll kind of talk about the differences. So in each of these situations, the investor and the company don't have to talk about valuation, at least not necessarily, but there are reasons to do so.
Yeah.
But what the investor is basically getting is a instrument that will convert into stock typically at the next priced round. In other words, typically a preferred stock financing. And what the concept here is what the investor is basically saying is, look, neither the company nor us is smart enough at this point in time to figure out what the company's really worth.
Yeah.
So rather than go through this process to try to come up with a valuation that may not be really meaningful, we're going to basically commit to investing a certain dollar amount, and we're going to have that dollar amount convert when the smart person comes in downstream and puts a value on the company.
Yeah.
Now, to reward me as the investor for coming in early and taking on more risk, not only am I going to convert at the next round, but I'm going to convert typically at a discount. Okay, I'm going to get more shares for the dollar to reward me from the risk of coming in earlier.
Right.
Sometimes we have what's referred to as a cap. In other words, that I'm not going to convert at a higher valuation than a certain dollar amount, again, to further protect me from losing too much value between now and the next round.
Yep.
How the convertible note, the safe, and the KISS all different. So the KISS and the safe all act the same in that they're not debt obligations, where the convertible note is actually a promissory note and it is a debt obligation. So the company does have the liability on its books, does have to pay a certain amount of interest, where with the safe and the KISS, it's not a debt instrument, there's no interest, and it's not a liability typically on the balance sheet. The differences between the KISS and the safe, I mean, probably the important thing to communicate is that you don't want the KISS if you're a company. Okay, the KISS is a much more investor favorable instrument. It's very draconian. What I can tell you is, having done hundreds of safe instrument convertible notes, I've only done maybe 1 or 2 KISSes, because most of the time my clients have been successful in negotiating it away. It's a bad deal for the founder. Try to avoid it. Try to move the investor to a safe, where the safe is a much more neutral and therefore much more founder-friendly instrument. So for the company, you'd rather not have the debt obligation. So the safe is going to be the preferred instrument out of the 3. I would rather see my client go with the convertible note over a KISS, just because the terms of the convertible note, even though it is debt, tend to be much more favorable to the founder than what it would be for the investor.
That was amazing answer to a very complex subject. So thank you very much for dumbing it down, because that was really, really good answer. All right, so Bruce, back to you. Last question for you. So how does someone get protection against maybe a trademark and copyright?
Sure. Well, those aren't my particular expertise, but they are important parts of intellectual property. So it's good that we talk about them. To get protection for trademarks, I mean, you already get, it's also true for copyrights, you already get some level of protection just by using the trademark in commerce.
Okay.
If you're only using the mark locally, you can get local protection of your trademark as long as you've been using it for a sufficient amount of time. But what you really want to do to get, for any startup that has any desire to go national or more, is you want to file a trademark application to get federal protection. That means that regardless of whether you're using it only in California initially, if you get the registered trademark, you can get protection across the United States.
Okay.
So the U.S. Patent and Trademark Office issues trademarks like they do for patents, and they can also be used for preventing importation of goods, such as patents can as well.
Okay.
In order to get that federal registration, though, you have to show to the USPTO that the mark is distinctive over existing marks that are being used for similar goods and services, and you have to eventually use it in interstate commerce. Although you can file your application initially before you've gone submitted your mark or used your mark in interstate commerce. That's called an intent to use application. I intend to go to interstate commerce at some point, and you have plenty of time once you get that application issued to get the final registration by going through interstate, using the mark in interstate commerce. For copyrights, it's very easy to get the national protection. You can just submit a sample of it to the U.S. Copyright Office.
Okay.
It's just there's a small form to be filled out that you attach with the sample of the copyrighted material, and then you get the federal copyright protection. But even short of that, it's good for any materials, brochures that you put out, various other information that the company is putting out, images, for example, to use the C in the circle attached with the year that you're using you're submitting the copyrighted material publicly, and then the name of the owner, and say all rights reserved. If you've ever seen somebody's PowerPoint presentation,
Right.
Generally you see at the bottom of each of their slides, hopefully they have that type of a little notation, and that can help prevent somebody from saying, "Oh, I was an innocent, non-willful infringer of your copyright."
Yeah. All right. Well, thank you. Thank you both. So I'm going to ask each one of you to give me one recommendation, one advice for the listeners, for entrepreneurs, from your perspective when it comes to their startup. So I'm going to do a couple of closing words, and then I will come back to you. So think about that one advice or one recommendation. I'll be right back. So thanks, everyone, for listening today. Again, if you have not subscribed to our YouTube channel, please do it today, and also follow us on social media. This recording for this interview, this fireside chat, will be available by tomorrow morning on YouTube. So you'll be able to go to YouTube/Bismal Ventures and find it there. We have a workshop this week. It's a marketing workshop. It's on Thursday. It's 2 sessions, 2 hours each, June 18th and June 25th, 11 a.m. So please go on Eventbrite, and you'll be able to find information about the workshop if you're interested. Next week, we have Dave Burkus, who is a longtime TCA member and a chairman emeritus for TCA, also author. The week after that, we have Fred Haney. So please don't miss these 2 interviews. They'll be on over the next 2 Mondays. All right, so I'm back to you guys. Let's start with you, Bart. Bart, what is the one advice you can advise the listeners, the entrepreneurs?
So I'm a big proponent of networking. And my experience is my clients who are better connected and networked have better, stronger safety nets and resources when they get in issues. JJ and I met through networking. Bruce and I met through networking. My Rolodex, my contacts is all the result of networking. And the beauty is that I know who to reach out to, and I have great referrals from my clients, and there's a large growing ecosystem in Orange County for entrepreneurs. Make availability of it, keep networking. You guys are here on this channel because this is online networking in a COVID environment, but it's really important to get to know people, and more importantly, the right people. And you find those people through networking.
Yes, and when it comes to investors, I agree with Bart. It's building that trust relationship with investors, and that can only happen through networking, meeting investors, and build that trust relationship. So that can't just happen by going to someone and asking for $1 million. Bruce, what's your advice?
Sure. So first, I echo what Bart just said. When I heard your question, I was thinking about, okay, what do I generally see in due diligences when either I'm defending or I'm looking at maybe a target that my client is interested in, and the most demoralizing thing is when you find out on either side that the company doesn't own what they think they owned because they didn't button up the ownership when it was appropriate. They had some inventor included that maybe he was a university professor that was consulting. Well, they didn't get him to assign his rights to the invention. That's a problem. And finding it out during that crucial due diligence period can really throw a monkey wrench into the works.
That's pretty devastating. Yeah.
Yeah. So that's what came to my mind is be mindful of buttoning up that ownership of whatever intellectual property you think you have.
Right. That makes a lot of sense. Well, Bruce, thank you so much. Bart, thank you very much for being here today. I really appreciate your input, your insight, your knowledge and expertise. I'm sure the listeners also appreciate that. Thank you for being here. Again, this will be available by tomorrow morning on YouTube. And to the audience, we will see you next week. Dave Burkus is on next week. Have a good day.